Good afternoon, friends. In the lecture series on Fundamental of Investment, in my previous lecture, I was talking about derivatives. I talked about what is derivative, what are the different types of derivatives, and when I was talking about in my previous lecture on types of derivatives, two types of derivatives I talked about, that is forward and future. See, derivative is a contract of an underlying asset, and the value of the asset is derived from the underlying asset. Means it's a contract which is future oriented. And in the forward contract and in the future contract, the forward is a bilateral contract between the two parties to buy or sell an asset. The asset may be the financial asset, stock, index, the interest, exchange rate, or it may be commodities like metals, like grains, right? And to buy that asset at a predetermined price at a future date or before that. Unlike the forward contract, future contracts are exchange-driven trades. Exchange through contracts takes place through exchanges, and like the forward contracts, they are also the contract to buy or sell an asset at a specified price on a future date. The difference between the forward and the future is that in the forward it is a bilateral agreement, means there is no counterparty guarantee that the contract will be fulfilled. In the future contract, since it is exchange traded, the trades takes place through exchanges. So exchanges guarantees through clearing houses, they guarantees that the fulfillment of the contract takes place. And the third type of derivative that is very popular, which is called options. In today's lecture, I'll be talking of options, and in the follow-up lecture also we'll be talking of options. So as I said, there are three types of derivatives, financial derivatives: forwards, future, and options. In today's lecture, I'll be talking about options. So what options means? Options are the contract which provides the holder the right to buy or sell a specified quantity of an underlying asset at a fixed price on or before the expiration of the option date. See, if you go by these lines, what you find is that there are two parties. One is called the buyer, the other is called the seller. Buyer is called the option holder and the seller is called the option writer. If you read these lines, what it means, that option holder, who is the buyer, he gets a right to buy or sell in specified assets. Means he is by paying a premium, he is getting a right but no obligation. But seller has an obligation at the desire of the buyer to fulfill the contract. What it means is that there are two parties, the option writer and the option holder. Option holder is the buyer and option writer is the seller. Option holder, by paying a premium to the option writer, that is the seller, takes a right to buy or sell an asset at a specified price on a future date or before that. This is what we mean by option. Through examples, I will be explaining you, so that at that point of time it will become more clear to you what option contract is. Means it's like a derivative contract, not like it is a derivative contract, and very popular contract, very popular derivative form, which is widely being used. The person who acquired the right is known as option holder, I have already told you, or the option buyer. The person who grants this right is known as option seller or option writer. The price payable to this right, for this right, is known as premium or option premium and depends on the underlying assets or the securities. See, the option holder is buying a right without an obligation, right? So for buying this right, because the option option writer, the seller, is giving you the right to buy or sell. Means it is at the desire of the option holder, that is the buyer, whether to buy or sell that asset on a specified date at a specific price or not, or let the contract expire. For this, for getting this right, the buyer will have to pay certain price, and that price is called the premium. That is, while getting this right from the option writer, the option holder pays a premium to the option writer. Premium means the price, some money, you can say, right, in a layman form. And the price, the premium, depends on the underlying asset. What is the price? There are various factors which determines the price. I'll be talking of this. So the buyer of the option contract has a right but no obligation. As I said just now, that the buyer has a right, no obligation. When I'm saying no obligation, it is up to the buyer whether to get the contract fulfilled or let it lapse. Means if it is beneficial for the buyer to fulfill the contract, to get the contract fulfilled, then the buyer will ask the seller, or the buyer will insist to get the contract executed. Otherwise, the contract will lapse automatically after expiry date. So the seller or the writer of the option has an obligation but no right. Means once he takes the premium, once he takes the price from the option buyer, that is the option holder, then option writer has an obligation to fulfill the contract if the option holder so desires, right? So means the option holder has a right but no obligation. The option writer, that is the seller, has an obligation at the desire of the buyer. So we'll be using different terms. These different terms are used in the options. Let me discuss what these terms are. Excise or strike price. It is the specified price at which the option can be exercised. The excise price for a call option is the price at which the security can be bought. Means I'll be discussing in length. There are two types of option. One is called call option. Call option is the right to buy, and there is called the put option. Put option means right to sell. So it is the excise price for a call option is the price at which the security can be bought. See, when I said strike price, suppose today the price of Tata Consultancy Service, TCS, right, is 3,100 rupees. I come into a contract, I buy an option to buy this TCS on a future date or before that at the say 3,200. So what I am doing is I am buying a call option to buy the Tata's shares, TCS shares at rate of 3,200, right, 3,200 rupees. For this, I'll have to pay a premium. I'll have to pay the premium. It depends on various factors, right? So the price that I'll have to pay for buying this option is called the premium, and the price at which I'm ready to take, or means the price at which the contract takes place, is called the strike price. See, strike price is different than that of the current price. I am saying the current price is say 3,100 rupees of one TCS share, and as you know, there are a specified quantity that is being exchange determined, right? That is the standard. Since the derivative contracts are standardized contract, especially the futures and the option, they are standardized contract. So what will be the size of each contract? That will be determined by the exchanges. Say that suppose NSE decides that each lot of TCS will be 150 shares. So it means whenever an option contract is being bought, means contract will be, the size of the contract will be minimum of 150 shares of TCS. So a call holder who is buying the call option, he is making a contract with the seller that at 3,200 price, when the price is 3,200, at the time of expiry or before that, he has a right to buy this at a rate of 3,200 rupees. Means those people who are bullish, means people who expect the price will go up, they buy call option. I'll be discussing in length the call option and the put option. So means basically this, at this point of time, our endeavor is to tell you what the strike price is. Strike price means the price at which the contract takes place, in a simple language. So exercise price or a call option is the price at which the security can be bought. So the exercise price for a put option is the price at which the security can be sold. So there are two types of option. One is called call option, the other is called the put option. In the call option, the option holder, that is the buyer, takes a right to buy the share. In the put option, the buyer, that is the option holder, takes a right, buys the right to sell the security at a specified price. This specified price at which the contract takes place, it is different from the current price. Don't be mistaken by the current price. Current price is the market that is prevalent today at this moment of time in the market. The strike price will be different than or may be different than the current price. Option premium. Option holder, since the option holder is buying a right without an obligation, for buying this right, option holder will have to pay a premium, that is called the price, will have to pay the price. And this price, to whom it has to be paid? It has to be paid to the seller, the option writer, right? So this premium depends on the strike price. The strike price means the price at which the contract will take place, time to expiry. Longer is the time to expiry, more is the risk involved. So when the time period is long, the premium amount increases, and vice versa. Interest-free rate of return, right? See, when you are making a contract, you will also see that what is the interest-free rate of return. Or you can say risk-free rate of return. Interest-free means risk-free rate of return. Rather, instead of the word interest-free, risk-free rate of return is a better word, right? So what is the risk-free rate of return? Because that is the minimum return which one wants when you make a contract with anybody. So it depends on the strike price. It depends on, means the larger is the difference between the current price and the strike price, right? Less will be the premium in case of the call option, depending on the situation of the market, whether the market is bullish or whether the market is bearish. There are various factors. Basically, I would say the difference between the two. And time to expiry, risk-free rate of return, and volatility of the underlying asset. Volatility means what is the fluctuation of the underlying assets. I was taking the example of Tata Consultancy Services. So TCS is type of a stock where the fluctuation is normally I'm saying is less in the market as compared to the smaller companies. So such company where the volatility in the underlying asset is low, normally the premium is also low. In a stock where the volatility is very high, right? Suppose some metal shares, right? So metal shares, there is a lot of fluctuation. Metal prices are being determined by various factors, international and local factors. So in the metal shares, there is a lot of fluctuation. We call it high beta share. Means that it fluctuates more than the fluctuation in the market. If market goes up by 10%, these stocks goes up by more than 10%. So those stocks where the volatility is high, normally the premium is also high. What it means is that this option premium depends on the difference between the current price and the strike price. I would say what is the strike price, time to expiry, whether the time to expiry is a longer duration or a shorter duration, interest or risk-free rate of return, and the volatility of the underlying asset. If the stock, the asset is more volatile, the premium will be more. If the stock or the asset is less volatile, when I say asset is less volatile, it means the prices of the asset is less volatile, the premium will be low. Expiry date. See, whenever a contract of options takes place, it takes place for a future date, right? That future date is called expiry date. So the date on or before which the option may be exercised, because this contract will not be for an infinite period of time. If you recollect, when I was talking about the forward in my last lecture on the derivative, I was saying that in India, in the stock exchanges, especially the NSE and the BSE, last Thursday of each month is the expiry date of the stocks, of the index also, right? So if it is a 1 month contract, in the 1 month contract, last Thursday of each month is the expiry date. So on that day, you will have to fulfill the contract or let the contract lapse. If you so desire, especially the holder, right, on or before that, right. So this is basically expiry date. The expiry date simply is the date for which, means the maximum period for which do you make the contract, right. So option holder, it is a specified particular date, right. So option holder may be exercise the option on or before the expiry date, right, depending on the nature of the option. If the conditions are favorable to the buyer, else the option is left to the lapse. That otherwise, if the holder is not interested in getting the contract fulfilled, so by paying a premium, it will allow the contract to lapse. Now, after talking of the meaning of the options, let me discuss the difference between the future and the option, right. Future, I discussed in my previous lectures, is also a derivative. It's a type of derivative. It's also a contract between the two parties which takes place through exchanges to buy or sell an asset at a specified price, right, and on a specified date. So what is the difference between the two types of derivative? A future contract is a contractual agreement between parties to buy or sell a particular asset in future for a particular price on a particular date, right. It means both the parties, the buyer and the seller, are bound by the contract. That is, the two parties makes a contract to buy or sell an asset at a price which is predetermined at a predetermined date, I would say, right. Predetermined means after a period of time, which is a future date. On the other hand, options are contracts which provides the holder means the buyer, holder the rights to buy or sell a specified quantity of an underlying asset at a fixed price on or before the expiry of the option date. What you notice the difference between the two is, in the future contract, both the parties are equally responsible. They have the rights as well as the obligation to fulfill the contract. But here in the option contract, option derivative, only the holder, or I would say holder, has a right only but no obligation. On the other hand, the option writer has obligation, right. So if the option holder wants, the option writer will have to fulfill the contract. So option holder will always see what is in his benefit or in her benefit, right. If it is benefit for the option holder, the buyer, to get the contract fulfilled, right, get the contract exercised, then it will ask for it. Otherwise, it will allow the contract to lapse. But as I said earlier, that for getting this right, the option holder pays a price. That is, the buyer pays a price which is called premium. The other difference is rights. Both the parties have right to ask for the performance of the contract. Means both the parties have right as well as obligation. But here, in case of option, the option holder has only rights, no obligation. But obligation of means, if I put it this way, option holder pays a premium and keeps the right with itself, right, or himself. Seller, on the other hand, writer, does not have any right but only obligation. Payment. Both the parties are required to deposit initial margin. Because both these contracts, derivative contracts, whether future or options, they are exchange traded. They takes place through exchanges. So whenever future contract is being made by the two parties, right, they have to keep certain initial margin, right, because exchanges want that there is no default because of the fault of one of the party, either buyer or the seller. So what they do, they keep some margin. Whenever the margin means a percentage of the value of the contract that is being, and what will be the percentage, that will be determined by the exchanges. So buyer as well as the seller, both will have to keep the margin money, the initial margin money. But in case of option, buyer only pays the premium, right. The buyer will not have to pay, she will not have to pay any initial margin or the margin. But as far as the seller is concerned, the seller will have to deposit the margin, right, because option holder, that is the buyer, if it will be in the benefit of the buyer at the time of expiry, then only it will ask for the fulfillment of the contract, right. but the option seller, he or she may be the loser, but he will have to fulfill the contract since he has already taken the premium for it. So the seller has an obligation to get the contract fulfilled or the contract fulfilled if the buyer so wants. So it means that the buyer, simple point is that buyer will not have to keep the margin, but seller will have to keep the margin. In case of future, both the parties have to keep the margin. Obligation, I have already explained, both the parties have rights as well as obligation, but in case of the options, only the seller has obligation to perform the contract. Execution of contract. Future contracts are settled through cash or delivery, but they are always executed. Right? So means they are executed. Practically speaking, they are not executed by physical delivery of stocks or physical delivery of metals, or means the price settlement, through price settlement, difference in the price, right? By and large, difference in the price, through paying difference in the price, the contracts are settled. Options, in case of options, buyer may or may not exercise the option, and therefore the option contract may lapse without being exercised. Right? So after talking of this difference between the futures and the options, now I will be talking about the types of options. Right? So there are two types of options. One is called call option, the other is called put option. What is type of call option? What do you mean by call option? What do you mean by put option? Depending upon whether an option is for a right to buy or for a right to sell. As you can see here, the call option is a right to buy and put option is a right to sell. Right? So if the holder, what we are talking is from the buyer's point of view. Right? There are two parties, the buyer and the seller. Buyer is called the option holder, the seller is called the option writer. Right? If the holder of the option gets a right and to buy, it is called call option. Right? And if the option holder gets a contract of gets a right to sell, then it is called the put option. So there are two types of option. One is called call, other is called put option. So depending on whether an option is for a right to buy or for a right to sell, the option can be classified into call option and put option. So let me elaborate a little bit about what is call option, what is put option. A call option provides its holder a right to buy a specified asset at a specified price on or before a specified date. Right? So the call option is bought when the buyer of the call option expect a rise in the underlying asset. Right? I am of the opinion that I expect that market will go up. Right? It is the right time to buy a call of index. Suppose today the Nifty, that is the index of the National Stock Exchange, is 16,500. I feel that in future after a month it may be 17,000. So what I will do, I will buy a call option of the Nifty, right, by paying a premium. On the day of the expiry, if the Nifty will be more than 17,000, which I am expecting that will be go up further, right? So just by paying a premium, suppose that on the day of the expiry it becomes 17,200. So I'll exercise my right to buy the index, right, and I'll buy this at 17,000 rupees, right. So 17,000 rupees means 17,000 Nifty. Now the Nifty is 17,200 on the expiry date. So the seller of the call, that is the call writer, will have to pay the difference of the price, whatever the price difference there is. Right? So call option is a right to buy. I will be discussing more of this call option in my next lecture. Thank you very much.